Hello everyone, thanks for checking out my video. A rally in the technology sector has pushed the S&P 500 to an all-time high last Friday after a shaky start to 2024. Other than S&P 500, Dow Jones also reached its own record high, while Nasdaq rose to its highest level in 2 years. Year to date, all three major indexes have rebounded nicely and they are all now in the positive territory. As the earnings seasons get ramped up and the first FOMC meeting of the year approaching, there is one warning sign that investors should take note of. Watch on this video to find out more about it. Okay, finally the S&P 500 has hit a record high after much anticipation since December. The rally was once again driven by mega-cap tech companies as Nvidia, Meta, and Microsoft all closed at new highs on Friday. It is not surprising to know that the tech-heavy Nasdaq was the day's biggest winner as it rose 1.7%. The index is also the best performing index year to date. Anyway, last week, the new retail sales data showed that December's holiday shopping turned out to be better than expected. Basically, retail sales increased by 0.6% for the month, which is higher than the estimate of 0.4%. What does this translate into? In layman terms, a resilient consumer spending could potentially fuel inflation and could possibly force the Federal Reserve to be more cautious in cutting interest rates. Separately, the University of Michigan's preliminary consumer sentiment survey showed a reading of 78.8 for January, its highest level since July 2021. For those who are not aware, the previous month's reading was 69.7. In addition, the expectations of inflation came in lower than expected at 2.9% versus the estimate of 3.1%. Again, in case you're wondering what does this mean and why are these consumer surveys so important, well, such survey gives us some insight into the psychological state of households and consumers instead of the actual reality of their personal finances. And when we know people are optimistic about the economy, we could kind of assume that they are more willing to spend or consume more. Anyway, both strong retail sales data and a positive reading from the consumer sentiment survey saw the expectations of first rate cut in March drop. That's a good thing in my opinion in terms of market expectations versus the reality. I will share more about this in the end thoughts segment. Looking ahead, earnings season will continue to ramp up this week. Another wave of financial companies will review their quarterly earnings, with American Express and Visa among the major players. Other notable names include Netflix and Tesla. For Netflix, their subscriber growth will once again be in focus as the streaming giant faces increasing competition and uncertainty in its niche. As for Tesla, analysts are expecting its year-over-year earnings per share to drop substantially. But because the market is forward-looking, the focus will likely be on the 2024's outlook and guidance for its gross margins and deliveries, especially when the company has been cutting their prices of its vehicles over the last few months. Other noteworthy names that are reporting this week include Johnson & Johnson, P&G, Intel, and General Electric. Lastly, PCE Price Index, which is commonly known as the Fed's preferred inflation gauge, will be released on 26 January Friday, and this could sum up a potential wild and volatile week. Let's now cover the technical analysis segment. Look at this chart. Look at how SPY sits so nicely on the green uptrend channel that I have drawn. It's obvious that SPY is trying to break out of the channel after failing to do so in the previous 5 occasions, and I think we will have an answer this week. So let's say SPY breaks out of this channel this week, watch out for one thing, watch for retracement. I mean, it can fly to 485, 490 or even 495 for that matter. I will not be chasing this rally. I will wait for the very first pullback outside of the channel. Specifically, I will see whether SPY will retrace to hit the channel line and bounce up, or will it fall back into the channel like what happened back in July 2023. If it bounces up, that's very bullish in my opinion, and SPY could hit 500 sooner than I expect. On the bearish side, 2 possible scenarios. One is what I have described, where SPY has a false breakout of the uptrend channel and fall back in. Second scenario is we have an immediate rejection at the uptrend channel and SPY falls back down. In terms of support levels, as shared previously, we have a mini support at around 467. In fact, I will stretch it a little bit to the first Fibonacci retracement level at around 467. So if SPY bounces up from this support zone of 465 to 467, then it could test the top channel line for the 7th time. But if the support zone gets breached, the next support is the 50 moving average at 461, followed by the next Fibonacci level at 454. If you were to ask me, I would actually love to see SPY pulling back to either of these two levels and bounces up. That kind of movement, to me, is an ideal scenario because such a significant pullback can help to cool off the market before it goes higher. Anyway, the market doesn't care how I think, so I just wanted to say, as long as SPY doesn't fall below and out of this uptrend channel, bulls are still pretty much in control over the bears. Let's now check out Apple's chart. Before I dive into the details, I just wanted to say it seems like there is some form of market manipulation going on. At the start of the year, we had two big downgrades, and we saw people, or perhaps institutions, taking profits by dumping Apple shares. Apple then fell from 190s to low 180s range. And just last week, when pretty much nothing has changed for Apple, Bank of America came out to say that there is a potential 20% upside for Apple. As a result, Apple's share price popped back to 190s again. I mean, all this happened within the space of 3 weeks, and almost nothing significant has changed for Apple. Yet, we had such drastic movements. Just imagine those big players took profits at 190s by dumping their shares, and then when everyone panicked, they secretly pick up shares at low 180s, and then they pump it up back to 190s again. This $10 movement may seem nothing to you, but imagine these big players are buying and selling hundreds of thousands of shares at one go, so we are talking about profits in the millions of dollars. And because of all these downgrades and upgrades, we saw a rare gap up and a gap down within a short time span of 3 weeks. With the latest rally, the first gap has been filled, so we are left with the second gap, which is a gap up between 182 to 185. And if you have been following me, you would know that gaps tend to get filled 80 to 90% of the time, so watch this gap very carefully if we have any retracement this week or next week. Anyway, before I go on, a quick shout out to Tommy. Thanks for purchasing a super thanks for my last video. I really appreciate it. For others who would like to support my channel, do consider buying me a super thanks as well, so that I can hit $113 to cash out my very first paycheck from YouTube. If not, you can also tap on the like and subscribe buttons. I am equally grateful and thankful of your support. And if you really think my content is useful, do share it with others as well. I mean, share the love, yo. Anyway, apart from the gap below, other support levels to watch for Apple include 189, 186 and 182, which are the 50 moving average and Fibonacci levels respectively. But these three levels, in my opinion, are not as significant as the 200 moving average, which currently sits at 180. I have actually shared in my past videos that ever since Apple embarked on this massive bull run in January 2023, there were only 2 occasions where it breached this 200 moving average, and last week was the 3rd time. On all 3 occasions, Apple bounced up. Therefore, in the near term, this should continue to serve as a strong support level. As for the bullish thesis, here's a good news for the bulls. MACD just had a bullish cross. Though it's not always guaranteed, it does increase the probability of Apple maintaining its current bullish momentum, unless we had a fake bullish cross on MACD, and MACD crosses down again. Okay, personally, I will watch the level 192 closely. A close above it will signify that the bullish momentum is continuing. Moving over to Tesla. In my last video, I shared that below 221, I don't see much support. Tesla could easily fall below 210 last week. That's what I said, and Tesla did exactly that. I hope that can help me earn a like button from you. Okay, so for this week, it's a very decisive week for Tesla due to its earnings report. Just to share, Tesla's expected move for this event is around $17, which translates to more than a 7% movement, courtesy to Tasty Trade for these statistics. Anyway, this means that from the current price of $212, Tesla is expected to go either above $225 or go below $200. And in case you don't know, during the last quarter, when Tesla missed on EPS and revenue expectations, the stock gapped down and plunged more than $20. I know a lot of people are leaning towards bearish movement post-earnings for Tesla, but in my opinion, it's really a flip of a coin. There's no sure thing in the stock market. As shared in my previous videos, there is a potential inverse head and shoulder pattern formed on both the weekly and daily chart. Let's focus on the daily chart. If Tesla goes below 200 this week, it's very bearish. Because it doesn't only break the psychological level of 200, it also invalidates the bullish head and shoulder pattern. From there, bulls would hope for Tesla to bounce from around 190 to 194 range, where the recent low was, in order to form a bullish double bottom. But if Tesla doesn't bounce from there, I'm not kidding you, but I think we could waterfall down all the way to 170's range. On the other hand, what if the market decides to do the opposite and Tesla goes up? That will be quite interesting, isn't it? Just to highlight, the previous occasions when the RSI indicator reached this level, or near to the current oversold level, we tend to see a bounce from Tesla. It's not a guaranteed indicator, but I thought it's worth sharing with viewers in case you did not pick that up. If we do get a bounce from here, it could be massive because bulls would definitely want to reclaim that 221 level that they lost last week. Further momentum could push Tesla towards 229 to 231 range, where the next Fibonacci level and the 200 moving average are. And a strong break above this area is an indication that the inverse head and shoulder is likely playing out. A further break above the purple downtrend line with solid strength, and I kid you not, we will be looking at 250s to 260s range in the next 1 or 2 weeks. All in all, it's going to be a pivotal and interesting week for Tesla. Buckle up your seatbelt and watch how it moves. It's gonna be a wild ride. Let's now jump over to Google. This week I am finally gonna share something different. Ignore the 127 to 139 consolidation zone that I have been talking about for the last couple of months. Google has finally broken out of that range convincingly. For the last 8 trading days, Google has been closing above 140. That's very convincing. Not just that, in my last video I shared that we would want to see Google climbing above 145 to show us that it isn't a false breakout that we saw previously. And it did. So right now, I think the bulls will have a chance to bring it up all the way to 149 to 150 area before resistance comes in. The resistance is formed by the top end of this green dotted uptrend channel as well as the Fibonacci extension level. In fact, I wouldn't be surprised if it charges towards the all-time high at 151.5. Honestly, in my view, there is little reason for Google to lose its bullish momentum until its earnings, which is on 30th January. If anything, it is only going to be a small technical pullback due to overbought situation. In other words, Google should continue to stay above 140 even with a pullback this week. The bearish thesis will only play out when 140 breaks, and coincidentally, 140 or 139 falls on the bottom end of this uptrend channel. So yeah, if only 140 gets breached, then bears could be back. But just to clarify, a slight intraday drop below 140, or maybe even if Google closes below 140 for about 1 or 2 trading days, it really doesn't mean too much. I would say if only Google starts hitting 133, then bears are making a slight comeback. Okay, all in all, it appears to me that Google could be forming a new base between 140 to 145 area. We could see another round of consolidation. But to be honest, it's really difficult to ascertain this consolidation theory right now. Let's visit this again when the earnings are out. Alright, let's now check out my options trades. So last Thursday, 18 January, I sold a new cash secure put on Tesla with a strike price of 170, expiring 1st March. The thought process behind this trade was quite straightforward. In fact, if you could recall, in my last video I shared that I want to see Tesla to flush a bit more before going in. That was when Tesla was at around 220. Basically, I was waiting for my technical analysis to play out, which is once 221 breaks, 210 and below will be very much in sight. And it happened. Tesla lost 221 and it fell all the way to 208. So do stay subscribed to my channel for such weekly technical analysis, alright? Anyway, the moment Tesla hit 210 last week, I stepped in to sell that put option. Was I too anxious? Could I have waited a little longer? Maybe. But that's also because I wasn't quite sure how low the market makers can bring Tesla down. 208? 205? Okay, in case you go thinking, wow, Tesla is on this very steep downtrend, why am I still selling a cash secure put, which is a slight bullish move? Alright, so if you followed my earlier TA, you would know that its RSI indicator has reached an oversold level. In the previous rounds when the RSI were at these levels, Tesla rebounded. Yes, there were occasions where it bounced up and fell further, but by then, time decay has already set in. But that said, I must still admit and declare that this is a very risky trade because earnings report is just around the corner. Poor earnings could easily send Tesla below $200. Therefore, to give myself some buffer, I chose a strike price that is far out at 170. This means Tesla has to drop another 19% after dropping 14% over the last 1 month, making it a more than 30% decline in total. Possible? Well, yes, but the odds is probably not super high. Apart from strike price selection, knowing Tesla could fall below 200 if earnings are bad, and to manage my risk, I chose a further away expiration date to give myself more leeway and to also make use of time decay or extrinsic value of the option. But if all else fails and Tesla closes below 170 on 1st March, I may just take the assignment of 100 shares. I mean, Tesla at 170, I think the upside from that level is quite a lot, at least in my personal opinion. Alright, next up, I have this Tesla cash secure put that is expiring this Friday 26 January. The strike price is 190. In short, if Tesla doesn't close below 190 on the expiration date, then the contract will expire worthless and I will get to keep the full premium or profit without doing anything. But as shared earlier, Tesla's earnings can swing the share price wildly in either direction, so I will be keeping an eye on this contract. I mean, I may just close it early if I have to. Alright, if you have no time to listen through this entire end thoughts segment, let me give you a too long didn't read, aka a summarized version. So, I have previously shared that when a stock or an index for that matter hit an all-time high, it is usually followed by a typical movement, which is it tends to go up a little higher more before having a significant pullback. The reason is quite simple. When a stock hit an all-time high, euphoria and FOMO investors will step in and sellers will dry up because nobody wants to sell when the bullish momentum is so strong. Every bull is watching and hoping the market to continue to fly higher. With this, the stock or index will face little resistance and move a bit more higher, to a point where it gets very or overly extended. That's when people will be like, okay, let's take some profits off the table. That is also when a significant pullback will come. Let me give you an example. Microsoft, check out the chart. As you can see, every time when it reaches an all-time high, it will still go up a little before pulling back. Same goes to Apple. It hit all-time high twice in the last 6 months, and it pulled back on both occasions. Just to add on, the pullbacks were quite significant as you can see from Apple's chart. But going back to Microsoft, even when the pullback is of a smaller scale, it's still about 5.5%. With all this being said, ultimately no one can accurately predict the magnitude of the next pullback. It could be a small blip like what happened at the start of 2024, or it could be a bigger magnitude that happened from August to October last year. But since S&P 500 is usually less volatile, I thought 5% could be a good benchmark. That said, I could be wrong and SPY may just charge towards 500 without a 5% pullback. Okay, that aside, it seems like the stock market keeps pushing to new heights as investors focus on the good news and ignore the bad news, such as potential rise in inflation again, strong labor market and consumer spending, geopolitical tensions, etc. Maybe it's because none of this have actually caused a massive negative impact to the overall economy yet. In my last video, I shared that the potential near-term threat that I saw was the mismatch in market expectations of rate cuts versus what the Fed has potentially envisioned. To recap, Fed doesn't seem like they are ready to cut rate in March. Yet earlier on, the market expectation indicates a 70% odds that the Fed will do it in March. Also, the market is expecting 6 to 7 rate cuts in total this year, while the Fed was only signaling about 3 cuts. However, the good news is that the market expectation of a rate cut in March has dropped significantly to about 53% at the time of recording. And this is what I have been talking about. I was hoping that the market can quickly adjust their expectations to Fed's estimates. And it's good that they are doing it right now. This latest 50-50 odds is definitely more realistic in my opinion. Finally, if you could recall, I was saying the S&P 500 could reach all-time high by the end of center rally, which was the first week of January. It didn't materialize, I have to admit that. So in the end, I was 2 weeks early as the index hit record high last week, but I am glad that it eventually did. From this point, I think big tech earnings and the upcoming FOMC meeting will take the center stage. Earnings will ramp up these 2 weeks, especially for the AI and technology giants. With the market hitting all-time high into the earnings season, there is definitely some risk that expectations are too high. And given the typical retracement post all-time high movement, I will not chase this rally right now. I will let my winners run, sit back and watch the earnings, and then wait for opportunities to pick up shares. That was for my long-term portfolio. As for options trading, I will still do it regardless of the market direction. So do stay subscribed if you want weekly updates on my trades, general market outlook and all the whatnots. And don't forget to like the video if you found my content useful. Thank you.